Greetings class and welcome back. This is the Accounting 201 exam number 2 problem review video that I mentioned I would prepare in class yesterday. So here it is. On June the 2nd, first of all we have Craig's snowboards using a perpetual inventory system and the gross method of sales, accounting for sales, which means we're going to use the sales account and all sales will be recorded at gross amounts, and then if we have any, we're going to use a sales returns account, returns and allowances, that reduces the value of sales, and a sales discounts account, which also reduces the value of sales. So here we are on June the 2nd, and we sell merchandise to General Sports Store on credit for $4,800. So we're going to have an accounts receivable with the store for $4,800 and a credit to sales for $4,800. Okay. Also on June 2nd, we're going to record the cost of these sales. So we're going to have cost of goods sold of $2,700. And we're going to credit merchandise inventory because we're moving that inventory out because it's been sold. All right, so we have two parts in the perpetual method. Then on June the 4th, we have a return where the retail value of the return was $200 and the cost was $110. So we're going to have two parts to this journal entry as well. We're going to start with the sales, returns, and allowances, which records the return at retail, which is going to be $200. And then we credit accounts receivable because we want to reduce the amount of the balance that they owe us. So we have a sales, returns, and allowance debit for $200. That reduces sales. And accounts receivable credit reduces the value of the accounts receivable account. Now for the 110, we have to reverse what we did up here with the cost. So we debit merchandise inventory for 110. And we credit cost of goods sold for 110. All right. Okay, so that basically is what we need to do for June the 4th. Now on June the 13th, they're going to pay us here. June the 13th, they pay us for the merchandise sold on June 2nd. So on June the 13th, we're going to figure out they purchased $4,800 originally, returned $200, so they have an accounts receivable balance of $4,600. We multiply that times the 0.01, which is 1%, and we get a discount of $46. We subtract this from the retail, so we have 46, or from the balance in the account, and we get the amount of cash that we will collect, $45.54. So on June the 13th, we're going to debit cash because we receive cash, $4,554. We're going to debit sales discounts for $46, and we're going to credit accounts receivable for $4,600. Okay, that takes care of problem number 1. This Johnny Cake Restaurant example here says they're using the periodic, but we're not really. We've been working with perpetual, and that's what we'll use here. So this is a perpetual inventory method. And so Johnny Cake purchased merchandise on account or on credit from Foster Foods for $9,000, terms 210, net 30, FOB destination. That means we're not paying for the shipping, all right? FOB destination means the shipper pays. And here it says so. Transportation costs of $350 were paid by Foster. So we just disregard this. This does not come into the equation at all. So on August the 10th, we have Johnny Cake purchasing merchandise on credit. So we're going to have a debit to merchandise inventory. Remember, we're using the perpetual system. Okay, merchandise inventory of $9,000 and a credit to accounts payable for $9,000. That's all there is. When we're using perpetual for purchases, we're only interested in cost. On August the 12th, Johnny Cake returned $600 of merchandise from the August 10th purchase. So on August the 12th, our return is just going to be a debit to accounts payable for $600 and a credit to merchandise inventory for $600. We're taking this out of merchandise inventory and sending it back, so we're reducing the amount that we owe to Foster. And then it says on August 19th, Johnny Cake paid Foster for the August 10th purchase. So on August 19th, we're going to calculate whatever the purchase was minus the return. So we have the initial purchase of $9,000 minus $600. We have a balance of $8,400. And our discount over here is 2%. So we're going to take that times 2%. And that gives us a discount of $168. Okay. So on this journal entry, what we're going to do is we're going to debit accounts payable for the full balance that we owe. So accounts payable, and this is the balance we owe right here, is $8,400. We're going to have a discount that applies to merchandise inventory. We're reducing the value of merchandise inventory with the discount. So we credit merchandise inventory for $168. And then we credit cash for the difference, which is $8,232. And so that is the cash that we're actually going to pay out. All right. So that is problem number 2. That's on the purchase side, using a perpetual system. All right. Let's go down here to the next one, number 3, and this is starts on this page, but it says the company made the following purchases and sales during the month. So they have a purchase of 380 at 15, a purchase of 270 at 17, 270 units. And then over here we see they have another purchase on May 20th of 300 units at 22. If the company uses the weighted average method, periodic method, what would be the cost of any inventory? So over here we're going to calculate that. So when we come over here, we're going to calculate the cost of the items that we purchased. The first thing we're going to do, we're going to figure out how many items did we purchase and what were their costs. So we're going to start with 380 units times $15. That'll be $5,700. We'll have 270 units at $17. That'll be $4,590. And then we'll have 300 units at $22. And that's going to be $6,600. And then we total up the cost, and we total up the units. We have 950 units purchased, and our total cost will be $16,890. So in the weighted average method, what we're going to do is we're going to take the cost that we calculate divided by the units we purchased to get a weighted average cost. In this case, that'll be $17.78 rounded. This is a rounded number. And then we have to figure out, okay, well, how many units did we have in ending inventory? Well, we have two sales identified here, both 400 units. So add those together, we get 800 units sold. And we're going to come over here and subtract out the 800 units from the 950, and that means we have 150 units left in ending inventory times the $17.78, which is the weighted average of all these purchases, and that gives us a cost of $2,667. Okay, that's the cost of ending inventory, right, using weighted average. By the way, weighted average is a relatively straightforward method. So anyway, just to let you know, this is a good problem, the weighted average one is, that could appear on the exam, something like it. Number 4, it says Forever Young Games Stores has taken a physical count of its inventory, and after reviewing the accounting records and documentation, they've identified the following items. They have an indication that $30,000 worth of games were shipped to Forever Young Game Stores on March 27th, FOB shipping point. That's important. The games and invoice did not arrive until April 2nd and were not originally included in the physical count. B, an invoice from Gamers Inc. indicates that $8,000 of games were shipped to FYG on March 29th, terms FOB destination. The games and invoice did not arrive until April 2nd and were not included in the physical count. Calculate the amount that should be reported as ending inventory for FYG. So basically all they're saying is which of these items should be included in inventory. We know that the ending inventory count was $440,000. So the ending inventory before adjustments is $440,000. Because letter A was shipped FOB shipping point, that means we pay the shipping. Free on board shipping point means the customer pays shipping. And if the customer pays shipping, they own the goods right away. These should be included in inventory because they were shipped out FOB destination, so our FOB shipping point. So we're going to add those in. And because these were FOB destination, we don't own them yet. We're not paying for shipping, the shipper is. So the games and the invoice haven't arrived, so we don't count it. So because these goods are in transit, and as soon as they're placed on the truck, because we purchased them and are paying shipping, we own them. So the adjusted inventory will be $470,000. Okay. A question similar to this that will ask you what should be included in inventory is a good one on the exam. On the exam, I won't ask you to do two things here. I'll only ask for one. But just to give you an idea here, they calculate the days sales and inventory before and after the appropriate adjustments. So before the adjustment, the days sales and inventory is going to be the ending inventory divided by cost of goods sold. So we have an ending inventory of $440,000 divided by a cost of goods sold of $2,000,001. And then we multiply that by 365. The result of this computation will be 76.5 days. That means we have 76 and a half days in ending inventory. That's how long ending inventory will last at this point. After the adjustment, the ending inventory is now going to be $470,000, but cost of goods sold doesn't change. Still $2,000,001 times 365. That gives us 81.7 days in ending inventory. So that tells us how much is in ending inventory. Okay. Now, like I said, when we do open-ended problems on the test, there will be a few, 3 or 4 maybe, but you'll do one step. You won't have to do a bunch of steps. So where we have 2 items here, you'd have to do one of these. So be prepared for that. Okay, so in number 5, somehow it goes across the page again. We have a company with the following inventory costs. They have letter A, product A with units on hand, 10 units, unit cost of 5, market value of 6. We come across over here to the rest of it. So let me rewrite that. So for product A, we have 10 units on hand, cost is 5, and market is 6. For product B, we have 50 on hand, the cost is 8, and the market is 7. For product C, we have 35 on hand, and the cost is 10, and the market is 11. They want us to compute the lower of cost or market for each item. So we would do it like this. For letter A, we're going to calculate the cost and the market. And what we'll do, basically, is take 10 times the units on hand times the cost, so we have $50 cost. 10 times 6 is $60 for the market value. So which one of these are we going to choose? Well, we're going to choose the cost amount here at $50. For letter B, we do the same thing. 50 units times 8 is 400 for cost. 50 units times 7 is 350 for market. So here we're going to choose the market cost, okay? Or the market value, not market cost. There is no cost in the market. It's the value. And letter C, we take 35 units times 10. We get 350. And then 35 units times 11 gives us 385. And so we'll select the 350 right here. So out here we're going to have the LCM, lower of cost or market, is going to be 50, 350, and 350. And if we added the total up, that would be $750. But they ask you just to identify which one are you going to pick, the lower of cost or market. This is a really good problem. Anticipate something like that on the exam for sure. Number 6, this is the same inventory facts that we had earlier in number 3, but now we're using, instead of weighted average, a FIFO periodic inventory method. Remember, FIFO is first in, first out. Meaning the first items we buy are the first items we sell. So what we're going to do is we're going to, again, total up all the items we purchased. So we purchased 380 items at 15. That's 5,700. We purchased 270 at 17, and that's going to be 45.90. Then we purchased 300 at 22, and that's going to be 6,600. So once again, our purchases in total are 16,890, and the items that we purchased, the total of them, are 950. Because they don't give it to us, we need to figure out how many units we have sold. So we add up this 400 and this 400, and we get 800 units sold. So we have the purchases here minus the units sold gives us our ending inventory of 150. Now, we're not doing the weighted average method. Instead, we're doing first in, first out. And since we're doing first in, first out, we're going to assume that these first items purchased up here were included in the units that were sold. An easier way of doing this is to look at how many units you have in ending inventory under first in, first out, and then start with the last layer of inventory and work backwards. So I have 150, and that's less than the 300 in this layer of inventory. So I can take all 150 units from the last layer of inventory at the $22 cost, and that will give me a cost of ending inventory of 3,300. Okay? All right. Now, if I give you a problem like this on the exam, and there will be questions about inventory, you can anticipate some of this, but you won't. Some of this will be given to you. You won't have to guess at it. Okay. All right. So we're up to number 7. Petty cash fund was originally established with a check for $100 on August 31st, which is the period end. Okay, so we're up to number 7. This one says petty cash fund was originally established with a check for $100 on August 31st, which is the period end. The petty cash fund included the following: we had 43 receipts for $43.50, $11.85, and $39, and cash remaining in the drawer was $4.25. The question we want to know is how much cash should we have in the drawer, because we need to compare it to what we actually have here. So we're going to basically add up these receipts or take them out of the petty cash fund. So we're going to take the petty cash balance, $100, and we're going to subtract $43.50, $11.85, and $39, and we will get $5.65. This means we should have $5.65 in cash in the drawer. Because there's less in the drawer than what we have, there's a shortage. I'm not showing it here, but the requirement for this problem is to write the journal entry replenishing the fund. So to replenish the fund, we're going to recognize all of these as expenses. So we debit the expenses. Postage, expense, office supplies expense. Hang on a minute. Office supplies expense. This is $43.50. This is a debit. $11.85 is a debit. And equipment repair expense is a debit of $39. Okay, so now we know what the difference is here, okay? We have a difference between what should be in the drawer and what is in the drawer. The question is, should it be a debit or credit? Well, the answer is if the amount that should be there is greater than what we have in the drawer, it's a debit. If it's the other way around, it'll be a credit. So we're going to have cash shorten over short and over for $1.40. And then we will credit cash because we're going to take cash out of the checking account and put it back in petty cash for $95.75. Okay? All right. That takes care of number 7. Okay, it takes care of number 7. All right, let's move on to number 8. And this is another one. 7 was from chapter 6 as well as number 8. So number 8 is a cash register problem where we have a cash register receipt showing $1,957 and the amount of cash in the cash register is $1,951. Prepare the journal entry to record the day's cash sales. This is a lot like petty cash in that if the amount in the drawer, the amount we should have in the drawer is based on this record we have right here. The cash register's record or tape shows $1,957, but the amount that's actually in the drawer is $1,951. Because we have less in the drawer than what we should have, we're going to debit a cash shorten over for the difference. If we had more in the drawer than we should have, it would be the reverse. So the journal entry here will be a debit to cash because we're going to record the amount of cash we received of $1,951. We're going to debit cash shorten over for $6, and we're going to credit sales for $1,957. Okay, number 9 is really a question about internal control, and it just asks you to identify the items that are strengths and the ones that are weaknesses. So basically, looking at number 1, it says the receiving department manager places an order with a vendor for merchandise inventory. That means basically they don't necessarily need approval, so this one would be a weakness. If we were looking at this, we would want a voucher system in place to make sure the department manager had approval to order the goods. Number 2, a voucher is used to certify a transaction and authorize the recording of the liability. This one is a strength. Anytime we use a voucher system, we consider that a strength. The voucher system basically means you can't do transactions without having approval. Number 3, goods are received by the receiving department and documented with a receiving report. This is also a strength. Basically, the receiving report is a check on the invoice. In other words, the invoice doesn't come to the receiving department necessarily. The invoice goes to accounting, but this way they can check and see what they actually received and compare that with what they have on the invoice. Number 4, the accounting department pays the vendor invoices before goods are received. Well, this is a weakness. We should never pay for goods before we get them. We should, if we're ordering large amounts of product, we should wait and make sure we receive them before we actually pay for it. And then the last one, number 5, invoices are paid after completion of the invoice approval, documenting the purchase requisition, purchase order, receiving report, invoice, and approval for payment. This is definitely a strength. So the strength ones are 2, 3, and 5, and the weaknesses are numbers 1 and 4. Just know that you'll need to understand what an internal control weakness or strength is. Okay, well, that's the video for the review. If you have any questions about this, please reach out and let me know. And I hope this helps.